Can I retire comfortably at 45 with $5 million? That's the question. And that's in this article with Yahoo Finance. So let's see what they have to say about it. And I'll comb through and help you discern truth from falsehood and have a little bit more critical thinking skills when it comes to finances, because I just feel like we've been fed a certain narrative that high risk equals high return, and that you're in it for the long haul, and it takes money to make money, and you should accumulate and diversify your portfolio and set it and forget it and invest early, often, and always, and retirement's the key. And so I want to look at that from a different philosophy, but also see what they come up with that might be really useful, or what we might want to ask different questions. So it says, if you have $5 million saved and you're thinking of retiring at 45, the good news is you can certainly do so. So first off, 45 years old to life expectancy, we're talking about, quite a while here, right? Maybe 40 years of retirement? 40 years, like, do you really want to retire? Now, if you're like my dad and you're a coal miner, the answer is definitely yes. But what if you didn't retire from value creation, but you retired into something you really enjoyed, or you found a career that was fulfilling and you still took trips and did some of the stuff, but like just to be totally retired, well, when you're not in control of your money, or if you don't have much purpose, or that money starts to feel scarce and all of a sudden none of your friends are retired, maybe you're not doing anything that's all that fun and kind of sitting around. Just something to consider. It says the bigger question is how you need to plan your retirement around that amount and your early retirement age. So in this article, it's about taking a look at some of the common considerations for early retirement, even with a big nest egg. So they are telling you a financial advisor can help you plan for retirement and manage your investments. So the cost of retiring early, let's start there. Retiring at 45 is considered a significantly early retirement than normal. No shit, right? I mean, I guess Social Security payments kick in at 62, it's saying. So yeah, Medicare kicks in at 65. Your retirement will begin 17 to 20 years of living without the government aid that many retirees factor into their plans. Now, I'm telling you, if you're young, factoring in the government support might be a problem, because there's every dollar that goes into Social Security immediately gets borrowed by Congress and spent, and we're not that far away from more money going out than coming in. And so I think that the best thing is to plan for financial independence, where you have enough recurring revenue from your assets or cash flow. Also, sometimes people got passive income, but it's not always fully passive. But ultimately, when you have that, you have more choice, you have more options, and that's what a lot of the goal would be. It says you'll need to remember that with traditional retirement accounts like IRAs and 401ks, they come with plenty of tax benefits. You won't be able to access that money without a penalty until the age 59 and a half. That's not actually true. Standard, that's true, but you can use what's called a 72T distribution, 72T, which allows 3 different calculations. You can pick one, and you can start taking that money out between now and 59 and a half without penalty, but you have to take it out the entire time without stopping to avoid that penalty. So it says at 45, you could also still be dealing with costs that most retirees don't. Are you still raising children or putting a child through college? Are you still paying off a mortgage? You'll need to ensure that you factor those into your retirement plans. Okay, that's kind of obvious. However, with $5 million saved, you shouldn't have an issue covering the cost of living on your own before your Social Security and Medicare kick in. You just need to make sure you plan ahead. Again, kind of thanks, Captain Obvious. If you're ready to be matched with local advisors that can help you achieve your financial goals, get started now. So this feels as much like an advertisement than anything, because you can click that in the article. So it says, how far will $5 million go? The good news is, even if you don't invest your money and generate returns, $5 million is still enough that you could live off $100,000 a year for 50 years. The problem is, what's $100,000 going to be like 50 years from now? I mean, it's going to be worth $10,000. When we look at an inflation calculator and look at what inflation will do, I think it's going to be kind of startling at how much of an impact that's going to be. I mean, I don't know, inflation, how it is right now, is your money is cut in half every 7 years. So that $100,000 would spend like $50,000 if inflation kept up at this level. It's really high right now, so that's not likely to happen. But still, let's say that even half of that. Now, all of a sudden, in 14 years, that $100,000 is only spending like $50,000. And so if we go out to 28 years, it's spending like $25,000. So what good is it to say, oh, you can live on $100,000 a year for 50 years? That's crazy. So the $5 million, you could also live off your interest of your investments without depleting the principal. That is the original $5 million. So this is where, I'm going to have a link in here that you can go check out my book, What Would Billionaires Do? Because that book talks about how you can do more than just take your interest, to have some buoyancy and not have to pay as much tax because of these spend down strategies when you coordinate it with a strategy called cash flow banking. But it says, what's the best way to diversify your investments? Even the most conservative investments would likely generate enough for you to live on. As of April 2023, the U.S. Treasury issues 5-year notes with an interest rate of around 3.4%. If you put in $5 million, you could receive $170,000 annually in income based on that interest rate without ever touching your principal. But again, I just mentioned that we have some issues with inflation, especially when you're starting this young at 45, and that's a consideration. But also in retirement, what if they raise taxes? All of these dollars they're talking about is taxable. So that money comes in, you have to pay taxes on it. If they raise taxes, that's going to cut into what your income is going to be. And inflation's the other thing that I kind of mentioned. Or what if interest rates change? Right now, interest rates have kind of spiked, which is good news for retirees. But how long will that stay that way? And if those start to decrease, then what does that do to your income? And now you're kind of subject to inflation rates, tax rates, and interest rates as to predicating what your lifestyle is going to be like. So it says, as I mentioned above, it's best to diversify your investments. Investment types include tax advantage plans. It says 401ks and IRAs are tax advantage plans, but we're now talking about a 45-year-old that wants to take money out. It was tax deferred, so now it's all taxable unless it was a Roth IRA. So that tax advantage now becomes a tax disadvantage because you delayed the taxes. So 401ks and IRAs, and again, unless it was a Roth, saying using brokerage accounts, CDs, stocks, bonds, and more. Diversifying your investments allows you to manage your risk by not putting all your eggs in one basket. How many times have we heard this? But often this could become diversification, spreading yourself thin, getting in more that you know how to manage, or that it's not related to what I call your investor DNA. Your investor DNA, sorry, I said DNA, but DNA, your investor DNA is your values. Like what's important to you and are you paying attention to? It's what are your competencies? What do you understand and would know whether it's time to get out or you can actually, speak about what's happening. And then it's your drivers. Like, what do you have interest and passion and that you want to learn about instead of like, I don't know how many people love reading about all the different stocks in their portfolio if they know anything about the stocks or what's going on with those companies happening in those boardrooms. So diversification is almost admission of ignorance. Now, I'll admit, diversification can be a good preservation strategy and not having all your eggs in one basket if you're just handing it over to someone else. I understand why that could be a good idea unless you start investing in things outside of your expertise or have too many advisors or not sure how it's going to benefit you. Or in this situation, are brokerage accounts and stocks actually going to help you create cash flow? And is that volatility going to be something you feel comfortable with if you're retired and not earning money anymore? So it says, after all, once you retire, you likely won't have any new money coming in. Well, that's what I was kind of just saying. So you'll want to ensure that you're set up that you can cover your basic costs even if the markets are down. So they are saying maybe some fixed income, bonds or maybe fixed income like CDs and stuff like that. And it says you're also more likely to see larger returns on some higher risk investments. So this is the notion that they're telling you high risk equals high return, but in a place where you're taking money out, if you have volatility and it's up and down, it's called disinvesting. Think about it. $5 million, if there's a 10% decrease in the market, now you have 4.5, you lost $500,000. You got 4.5 million at work. Well, if you're still taking money out, it's starting to decrease that amount if it's more than just your interest. So you either have a decrease in income or you decrease your principal. And if you keep taking a fixed amount, it starts to accelerate those losses and deplete your principal. So you have to be careful with something called disinvesting. So it says what retiring at 45 with 5 million might look like. Once you retire, you'll likely lose your employer-sponsored health insurance, so you'll need to replace it. This is often one of the largest costs of early retirement, so you'll need to cover those expenses by yourself for 20 years until you become eligible for Medicare. For a single 45-year-old man living in Dallas, Texas, premiums through the healthcare.gov website start at about $350 a month. That's over $4,000 a year before any actual medical expenses kick in. Low-cost plans actually come with higher deductibles, meaning that they have a higher threshold of what you have to pay for before the insurance kicks in. So, all right, there's a good point they make there. Perhaps if you've invested wisely, you have quite a bit of your $5 million in retirement accounts like 401k plans and IRAs. Now, this seems insane. They're saying if you've invested wisely, you'd be better off with the $5 million in municipal bonds or cash value insurance, where you actually don't have to pay tax unless, again, it's a Roth IRA. So it says, while this is great for tax savings, you won't be able to use those funds without a stiff penalty for the next 14 and a half years. So you need to make sure that you've invested the remainder of your savings in assets that will pay off now. Okay, so now I'm saying, what a great idea. I hope you invested wisely, and then put your mind in thinking that wisely meant putting it in these retirement plans and saying, oh, but you can't get to 14 and a half years. But that's not true, because the 72T already taught you about. So they're not even giving you the right information. So that's kind of a crazy thing here. And it says it's great for tax savings. How is it tax savings if when you go to pull the money out, you still have to pay tax on it? Now, some people are going to argue and say, well, that money compounded without tax, and then you get to pull it out. But here's the deal. If I have $10,000 to invest, and I say, okay, I'm going to do a Roth IRA. I know that you can't quite put $10,000 in, but let's say it was $10,000 there or $10,000 in a 401k. So now after taxes, maybe you only have $7,500 to put in the Roth, because it's after tax money, where you have the full $10,000 go into the 401k. You're like, great, now I have $10,000 working for me. And let's say that $10,000 that grows to $100,000. You're like, this is awesome, right? But then when you go to pull it out, you have to pay tax, so you only get $75,000 of that. Well, guess what? The $7,500 you just pay would now be worth $75,000 tax free. There's no magic to it. You're either paying the taxes now or later. It's just are you going to be a higher tax bracket in the future or not? Maybe because of inflation you might be, or maybe because of tax hikes, because they're at $31.5 trillion of debt with the government. So just a couple things to kind of consider there. So if you're thinking about those treasury notes again, it's not a bad impulse. Let's say you have $2 million of your funds sitting in retirement accounts you can't touch till the age of 15 and a half. I've already dispelled that. If you invest remaining $3 million in a 5-year treasury notes mentioned above at the current rate of roughly 3.4%, you still be pulling in $102,000 a year. Now, I'm telling you, if someone has $5 million and they're probably not used to living off $102,000 a year unless they're in the money persona, a miser. So you can go to GarrettGunderson.com/quiz and find out what your money persona is. But a miser probably didn't spend a lot of money. But if you're someone that's a striver or high roller, this isn't going to be nearly enough money to live on and enjoy. So you have to start asking about quality of life. It says if you want a deeper dive into specific retirement could look like with $5 million, the bank, sit down and look at your expenses, the lifestyle you hope to lead in retirement, your life expectancy, and other factors. Take a look at a variety of assets and investments that could fund their lifestyle while minimizing risk. They just told you high risk equals high return, and now they're telling you to minimize risk. Well, which one is it? Seems contradictory to me. If you want expert help tailored to your exact situation, where they're still going to sell you funds, consider reaching out to a financial advisor who can work with on a retirement plan that meets your needs. It says the bottom line, if you've saved $5 million, you should be able to retire at 45 without any worries, as long as there's not inflation, as long as there's not major market losses. And, there's a lot of things they're not considering here. With some wise investments, which they haven't really talked about, careful budget planning, which means cutting out your lifestyle, you can have a long and happy retirement without any worries about running out of cash. That's just not true, because they've told you to put some of this money in the market, which there could be worries. Some of those businesses could not make it because of artificial intelligence. I just think that this is a naive article at best and contradictory at worst. So retirement planning tips, consider working with a financial advisor. I wonder if they've, somehow making money by promoting financial advisors here. How much you need to save for your eventual retirement lifestyle? If you're scratching your head at the question, consider using a retirement calculator. Look, here's my philosophy. Maximize your returns. Coordinate your assets, plug your financial leaks, focus on cash flow along the way, protect your downside. These are the things that I think are going to be really helpful. I think the book, What Would Billionaires Do, which GarrettGunderson.com/WWBD, go ahead and check that out for a very small investment. I think that's going to help you out and get past what some of this is talking about and can get you better than 3.4% without having to take a bunch of risk and actually get you tax advantages, not just tax deferral. So it's going to be less risk and crush this plan. You know what? That's the bottom line here. So hopefully this has been helpful and I've given you some resources to take it to the next level. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from. So go ahead and click through and watch the next video now.